everyone, and welcome to another Beta Alpha Psi meeting. Before I begin, can somebody just let me know if you could see the screen share, or is it still on the attendance?
Yeah, we see it.
We can see
Yep.
it.
Perfect, perfect. Okay, so today we're going to be going over tax preparation. So today is just going to be a tax preparation workshop. Um, there might be people in here that aren't interested in tax, and there might be people that are. If you are, this is really good. And if you aren't, could share this with somebody that is 100%. So let's get started. So what is tax preparation? So tax preparation is the process of preparing and filing tax returns to comply with tax laws and regulations. It involves collecting and organizing financial information, such as income and expenses, to determine the amount of tax owed or the amount of refund due. Tax preparation can be done by the taxpayer themselves using tax preparation software or by hiring a professional tax preparer. The goal of tax preparation is to ensure that the taxpayer pays the correct amount of tax, no more and no less, and takes advantage of any tax benefits for which they are eligible. By the way, if anybody has any questions, they could stop me. So why should you prepare your taxes? So there are several reasons why you should prepare your taxes. One, compliance with the law. So preparing and filing your taxes is a legal requirement in most countries, and failure to do so can result in fines and, of course, even criminal charges. Number two, accurate calculation of tax liability. Tax preparation helps you determine the correct amount of tax you owe, or, sorry, the amount of tax you owe, or the amount of refund you are due. This helps you avoid overpaying or underpaying taxes, which can result in fines or having to pay back money owed to the government. Third reason, maximizing tax benefits. Tax preparation allows you to take advantage of tax benefits such as deductions and credits, which can reduce your tax liability. By preparing your taxes, you can ensure that you are taking advantage of all the tax benefits for which you are eligible. Number four, improved financial planning. So preparing your taxes gives you a better understanding of your financial situation, including your income and expenses. The information can be used to improve your financial planning and make informed decisions about your financial future. And last but not least, peace of mind. Preparing and filing your taxes can provide peace of mind knowing that you have met your legal obligations and have taken advantage of any tax benefits of which you are eligible. So, what you need to start, personal information. This includes your full name, social security number, and contact information. If you are married and filing jointly, you will need the same information for your spouse. Number two, income information. This includes W-2 forms from your employers, 1099 forms for any other income sources, such as freelance work or rental property income, and any other documentation of income received during the tax year. Number three, expense information. This includes receipts and records of expenses related to your job or business, such as travel, supplies, and business-related meals. You will also need information about other expenses, such as charitable donations, mortgage interest, and medical expenses. Number four, tax forms. So depending on your situation, you may need to use different tax forms. For example, if you are an employee, you will need to use a 1040 form, and if you are self-employed, you may need to use a Scheduled C form. Number five, receipts and documentations. You should keep receipts and other documentations of expenses that you want to claim as deductions. This will help you ensure that you have the necessary information to support your deductions when preparing your taxes. Bank and investment statements. You will need to provide information about your bank and investment accounts, such as interest, dividend income, capital gains and losses, and contributions to retirement accounts. And last but not least, tax preparation software or tax professional. You can choose to prepare your taxes yourself using tax preparation software or hire a tax professional to do it for you. Having these items readily available will make the tax preparation process smoother and more efficient. It's important to note that it's better to have all the necessary information and forms together before starting the tax preparation process rather than trying to just gather everything while preparing your taxes. So, types of tax forms. There are many different types of tax forms that you may need to use when preparing your taxes, depending on your income, deductions, and other factors. Some of the most common tax forms include Form 1040. This is the main tax form used by individual taxpayers to report their income, deductions, and credits. Most taxpayers will use the 1040 form to prepare their taxes. So, Form 1099. This form is used to report various types of income, including interest, dividends, and miscellaneous income, such as freelance work. Form 1120. Form 1120 is the tax form C corporations use to file their income taxes. Once you completed Form 1120, you should have an idea of how much your corporation needs to pay in taxes. Schedule A. This form is used to report itemized deductions such as mortgage interest, charitable contributions.
Yeah. So, I totally forgot it was your birthday.
Sorry. Charitable contributions and medical expenses. Schedule B, this form is used to report interest and dividend income and is required if the total amount of interest and dividends received during the tax year is over $1,500. Schedule C, this form is used by self-employed individuals and business owners to report business income and expenses. Schedule D, this form is used to report capital gains and losses from the sale of investments and other assets. Schedule E, this form is used to report rental income and expenses, as well as income from other passive activities such as partnerships and limited liability companies. Schedule F. This form is used by farmers to report farm income and expenses. Form W-2. This form is used to report wages and other compensation received from an employer, including taxable benefits such as health insurance and retirement plan contributions. Form 4868. Use Form 4868 to apply for 6 more months under taxpayers who are out of the country and to file Form 1040, 1040 SR, 1040 NR, 1040 PR, or 1040 SS. So these are just a few of many tax forms that you need to use when preparing your taxes. It's important to carefully review these instructions for each form to determine which ones apply to your situation. If you're unsure which forms to use, consider seeking advice of a tax professional or using tax preparation software. So this is a Form 1040 example. So Form 1040 is the standard tax form used by individual taxpayers to report their income and calculate their federal income tax liability. The following are some important points to consider when completing Form 1040. Personal information. So you'll need to provide your name. Sorry, you need to provide your name, social security number, and other personal information on Form 1040. Income. So you'll need to report all sources of income, including wages, salary, tips, and other taxable compensation. You'll also need to report interest, dividends, and other investment income, as well as any taxable refunds, credits, or offsets. Form 1040 allows you to make certain adjustments to your income, such as contribution to a traditional IRA or student loan interest. These adjustments can reduce your taxable income and lower your overall tax liability. So if you choose to itemize your deductions, you'll need to report expenses such as medical and dental expenses, state and local taxes, and mortgage interests. Itemizing your deductions may result in a lower tax bill than claiming the standard deduction. And exemptions. You can claim an exemption for yourself and any dependents that you may have. Each exemption reduces your taxable income by a set amount. After you reported all your income and made your adjustments, you'll use the information on Form 1040 to calculate your tax liability. This will involve using tax tables or a tax calculation worksheet to determine the amount of tax you owe. If you owe taxes, you'll need to make a payment to the IRS. You can make a payment by mail, electronically, or through a tax professional. Once you complete Form 1040 and made any necessary payments, you'll need to file your return with the IRS. You can file electronically or by mail, and you'll receive a confirmation once your return has been accepted. So remember that these are just a few of the important points to consider when completing Form 1040. There may be other factors that apply to your specific situation, so it's a good idea to seek professional tax advice if you have any questions or concerns. It's a little blurry, but Form 1099 example. So Form 1099 is a tax form used to report certain types of income that are not reported on your W-2 form. Here are some important points to consider when dealing with Form 1099. Form 1099 is used to report a variety of types of income, including interest, dividends, rental income, and income from independent contracts. Form 1099 is typically issued by the entity that paid you the income. This could be a bank, a brokerage firm, landlord, or a client. The deadline for issuing Form 1099 is usually January 31st of the year following the year in which the income was received. If you receive a Form 1099, you'll need to report the income on your tax return. That means that you'll need to keep track of all your Form 1099s and include the information on your tax return. It's important to make sure that the information on your Form 1099 is accurate. If there is a mistake, you'll need to contact the issuer and have them correct it. If you fail to report income that was reported on your Form 1099, you may be subject to penalties and interest charges. You should keep a copy of all of your Form 1099s in case you need to refer to them in the future. And also remember that these are just a few of the important points to consider when dealing with Form 1099. For more information, it's a good idea to consult with a tax professional or the IRS. So, Form 1120 example. Form 1120 is a standard tax form used by corporations to report their income and calculate their federal income tax liability. The following are some important points to consider when completing Form 1120. So, Form 1120 is used by corporations to report their income, deductions, and credits, and to calculate their federal tax income liability. You'll need to provide information about your corporation, including its name, taxpayer, identification number, and the date of its tax year. You'll need to report your corporation's gross receipts and sales, as well as any other income received. If your corporation is involved in the sales of goods, you'll need to report the cost of these goods as well. You'll need to report all of your corporation's deductions, including business expenses, depreciation, and contributions to employee benefit plans. Your corporation may be eligible for certain tax credits, such as the Research and Development Credit, the Low Income Housing Credit, and others. After you've reported all of your corporation's income and deductions, you use the information on Form 1120 to calculate your tax liability. This will involve using tax tables or a tax calculation worksheet to determine the amount of tax you owe. If your corporation owes taxes, you'll need to make a payment to the IRS. You can make a payment by mail, electronically, or through a tax professional. And once you've completed Form 1120 and made any necessary payments, you'll need to file your return with the IRS. You can file electronically or by mail, and you'll receive a confirmation once your return has been accepted. So, Schedule A example. Schedule A is a tax form used to itemize deductions for individuals who choose to take advantage of this option instead of taking the standard deduction. Here are some important points to consider when completing Schedule A. So Schedule A is used to itemize your deductions, which can include a charitable contribution, state and local taxes, mortgage interest, and medical expenses, among others. In order to itemize your deductions, you must have sufficient itemized deductions that exceed the standard deduction amount. You can deduct charitable contributions that you made during the tax year. This includes cash donations as well as contributions of properties such as clothing, household goods, or vehicles. You can deduct state and local income tax sales and property taxes that you paid during the tax year. If you own a home, you can deduct the mortgage interest that you paid during the tax year. You can deduct medical and dental expenses that you had paid during the tax years as long as they exceed 7.5% of your adjusted gross income. There are limitations on the amount of some itemized deductions that you can claim, such as a cap on the amount of state and local taxes you can deduct. You should keep records of all of your itemized deductions, including receipts, canceled checks, and any other documentation in case you are audited by the IRS. Itemizing and taking your standard deduction, you'll need to compare your itemized deductions to the standard deduction to determine which option provides the greatest tax benefit. Now, Schedule B example. Schedule B is a tax form used to report interest and dividend income for individuals. Here are some important points to consider when completing Schedule B. So Schedule B is used to report interest and dividend income that you received during the tax year. This includes interest from savings accounts, bonds, and other investments, as well as dividend from stocks and mutual funds. If you have a foreign bank account or investment, you may be required to report the interest and dividend received by those accounts on Schedule B. You only need to report interest and dividend income if the total amount received during the tax year is over $1,500. Most interest income is taxable, although there are a few exceptions, such as interest from tax-free bonds. Qualified dividends are taxed at a lower rate than ordinary dividends, so it's important to know the difference between the two. You should keep records of all of your interest and dividend income, including 1099 form and other documentation in case you are audited by the IRS. If you have a foreign bank account or investment, you may need to file a separate tax form, such as a form 114, to report the account to the IRS. Schedule C. So Schedule C is a tax form used by self-employed individuals to report their business income and expenses. Here are some important points to consider when completing Schedule C. So Schedule C is used to report the profit or loss from a sole proprietorship or a single member LLC. This includes income from freelance work, consulting, or any other self-employment activity. To be eligible to file Schedule C, you must have a trade or business in which you are self-employed, and you must have received income from the business during the tax year. You'll need to report all of the income that you received from your self-employed activity on Schedule C. This includes income from sales, fees, and any other commissions. You can deduct expenses that are necessary and ordinary for your trade or business. This includes items such as supplies, utilities, rent, and advertising. You can also claim depreciation on business assets such as equipment, vehicles, and property. Now, if you use a portion of your home for your business, you may be able to claim a home office deduction. You should keep records of all of your business income and expenses, including receipts, invoices, and bank statements in case, of course, you are audited by the IRS. And after subtracting your business expenses from your business income, you'll calculate your net profit or loss, which will be reported on Schedule C. Now, if you have a net profit from your business, you'll need to pay self-employment tax, which covers your Social Security and Medicare taxes. Schedule D example. So Schedule D is a tax form used to report capital gains and losses from the sale of investments such as stocks, bonds, and mutual funds. Here are some important points to consider when completing Schedule D. So Schedule D is used to report capital gains and losses that result from the sale of investments. This includes sales of stocks, bonds, mutual funds, real estate, and other assets. The tax treatment of capital gain depends on how long you held the investment before selling it. Short-term capital gains, which are from investments held for 1 year or less, are taxed as ordinary income. Long-term capital gains, which are from investments held for more than 1 year, are taxed at a lower rate. You'll need to report all of your capital gains and losses on Schedule D, including the date of purchase, date of sale, and the sale price. The cost basis of an investment is the original price that you paid for it, plus any other cost, such as commissions and fees. You'll need to calculate the cost basis in order to determine your capital gain or loss. So the wash sale rule disallows a loss on the sale of security if the same security is purchased within 30 days before or after the sale. If you have both capital gains and losses, you'll need to net them together to determine your overall capital gain or loss for the tax year. Capital gains are taxed at different rates depending on your tax bracket and the type of investment. It's important to be aware of these different tax rates when determining your tax liability. You should keep records of all your capital gains and losses, including brokerage statements and other documentation, of course, in case you are audited by the IRS. Schedule E. So Schedule E is a tax form used to report income or loss from rental properties, royalties, or passive activities. Here are some important points to consider when completing Schedule E. Schedule E is used to report income or loss from rental properties, royalties, or passive activities. This includes rental income from real estate, income from limited partnerships, and income from passive business activities. If you receive rental income from a property, you'll need to report this income on Schedule E. You'll also need to report any expenses related to the property, such as a property management fees, insurance, repairs, and depreciation. If you receive income from royalties, such as from a patent or copyright, you'll need to report this you need to report this income on Schedule E. If you have income from passive business activities such as investment and limited partnership, you'll also need to report this income on Schedule E. If you have a loss from passive activities such as a rental property, you may be limited to the amount of loss that you can claim, depending on your level of involvement in the activity. Now, if you have a rental property, you'll need to calculate the depreciation of the property each year and report it on Schedule E. You should keep records of all you should keep records of all of your rental income and expenses, as well as records of any passive business activities, of course, in case you are audited by the IRS. So Schedule F. Schedule F is a tax form used to report income and expenses from farming activities. Here are some important points to consider when completing Schedule F. So Schedule F is used to report income and expenses from farming activities, including raising livestock, growing crops, and other agriculture activities. If you have income, if you have income from farming activities, you'll need to report this income on Schedule F. This includes income from the sales of crops, livestock, and other agricultural products. You'll also need to report any expenses related to your farming activities on Schedule F, such as feed and seed costs, labor, machinery, and machinery expenses. If you have machinery or equipment used in your farming activities, you may be able to start You may be able to claim depreciation on these items, which can reduce your tax liability. You should keep records of all of your farming income and expenses, including receipts and invoices, in case you are audited by the IRS. There are special tax rules and deductions available for farmers, such as the deduction for farm machinery and equipment and the Section 179 expense election. It's important to be aware of these rules and deductions when preparing your tax return. So Form W-2, which is the one that most people are probably used to. So Form W-2 is a tax form used to report wage and salary income to employees and the IRS. Here are some important points to consider when reviewing your Form W-2. So Form W-2 is used to report wage and salary income to employers and the IRS. Employers must provide employees with a Form W-2 by January 31st of each year. The Form W-2 reports the total amount of wages and salaries paid to the employee during the year, as well as any federal, state, and local taxes withheld from the employee's pay. The Form W-2 also reports the amount of Social Security and Medicare taxes withheld from the employee's pay during this year. If the employee participated in a retirement plan such as a 401(k) or a pension plan, the amount of contributions made by the employee and the employer during this year will be reported on the Form W-2. The Form W-2 may also report other deductions taken from the employee's pay, such as pre-tax health insurance and contributions, flexible spending account contributions, and wage garnishments. It's important to verify that the information on your Form W-2 is accurate, including your name, social security number, and wage and tax information. If there are any errors, you should contact your employer to have the errors corrected. You'll need your Form W-2 when preparing your tax return, as the information on the Form W-2 is used to calculate your federal and state income tax liability. So Form W-9. Form W-9 is a tax form used by individuals or businesses to provide their taxpayer identification number, also known as TIN, and certifications to requesters such as bank or payers of income. Here are some important points to consider when completing Form W-9. So Form W-9 is used to provide your taxpayer identification number and certifications for requesters such as banks or payers of income. The requesters use the information on Form W-9 to prepare an information return such as Form 1099. Form W-9 requires you to provide your taxpayer identification number, which can be your social security number if you are an individual, or your employer identification number if you are a business. Form W-9 includes certifications that you are not subject to backup withholding, and you are a U.S. person. It's important to carefully read and understand the certifications before signing Form W-9. If you are a sole proprietor or single member LLC, you should provide your social security number on Form W-9. If you are a partnership or disregarded entity, you should provide your you should provide your employer identification number on Form W-9. If you are a corporation, you should provide your employer identification on Form W-9, and the requesters must use the information provided on Form W-9 to prepare an accurate information return, such as Form 1099. If the requester knowingly uses incorrect information, they may be subject to penalties. So, knowing your filing status is an important factor in determining your tax liability and the tax forms that you need to use. There are five different filing statuses to choose from when preparing your taxes. First one is single. If you are not married and do not have a qualifying dependent, you can file as a single taxpayer. So, married, filing jointly. If you are married, you and your spouse can choose to file a joint tax return. This often results in a lower tax liability and can simplify the tax preparation process. Married and filing separately. If you are married, you and your spouse can choose to file tax returns separately. This can be a good option if one spouse has a large amount of income or deductions. Head of household. If you are unmarried and have a qualifying dependent such as a child, you may be able to file as the head of household. This is a status often results in a lower tax liability than filing as single. And qualifying widower with dependent child. If you are a widow or widower with a dependent child, you may be able to use this filing status for 2 years after the year in which your spouse has passed away. So it's important to carefully consider your filing status when preparing your taxes, as it can significantly impact your tax liability. If you're unsure which status to choose, consider seeking the advice of a tax professional or using tax preparation software. So, deciding when to file. The deadline for filing federal taxes returns in the United States is April 15th each year. However, there are several factors to consider when deciding when to file your taxes. If you're waiting for certain forms or information to be sent to you, such as a W-2 from your employer, it may make sense to wait until you have everything you need before filing your taxes. If you're due for a refund, there is no advantage to filing your taxes earlier rather than later. However, if you owe taxes, it may be helpful to file as soon as possible to avoid interest and penalties. If you have experienced a significant life change, such as getting married, having a child, or buying a home, it may be helpful to speak with a tax professional before filing your taxes. If you're self-employed, you may need additional time to gather information and complete your tax return. If you're unable to file your taxes by the deadline, you can request a tax extension, which will give you an additional 6 months to file your return. However, this extension only applies to the filing of the return and not the payment of any taxes owed. Overall, it's best to aim to file your taxes soon as soon as you have all the necessary information and forms. Filing your taxes early can reduce the risk of errors and give you peace of mind knowing that your tax obligations have been met. So, knowing what is tax deductible. So, when preparing your taxes, it's important to know what expenses are tax deductible. Tax deductions are expenses that can be subtracted from your taxable income, reducing your overall tax liability. Some common tax deductions include medical and dental expenses. You can deduct medical and dental expenses that exceed 7.5% of your adjusted gross income. You can deduct contributions made to qualified charitable organizations such as churches, schools, and nonprofit organizations. You can deduct state and local income taxes and property taxes up to a limit of 10,000 and 5,000 if married and filing separately. You can deduct interest paid on mortgage for your primary residence up to a limit of 750,000 and 375,000 if married and filing separately. And you can deduct interest paid on loans used to purchase taxable investments such as stocks and bonds. You can deduct contributions made to traditional IRA up to a limit of 6,000, 7,000 if you're 50 years or older, as well as contributions to other types of retirement accounts such as a 401k. You can deduct certain expenses related to your job or businesses, such as travel, supplies, and business-related meals. You can deduct losses resulting from theft or damage caused by a natural disaster, such as a hurricane or earthquake. Now, it's important to note that these are obviously just a few examples of tax deductible expenses. There are many other deductions available depending on your specific circumstances. Additionally, it's important to keep accurate records and receipts of all expenses you wish to claim as deductions. Now, understanding tax breaks. So, tax breaks, also known as tax incentives or tax credits, are special provisions in the tax code that allow you to reduce your tax liability. Tax breaks can be in the form of deductions, credits, or exemptions, and they are available for a wide range of expenses and activities, including charitable contributions. So, you can deduct donations made to qualifying charitable organizations. Mortgage interests. If you own a home, you can deduct the interest paid on your mortgage. State and local taxes. You can deduct state and local income, sales, and property taxes up to a limit. Medical and dental expenses. You can deduct medical and dental expenses that exceed a certain percentage of your adjusted gross income. Retirement and contributions. You can deduct contributions to a traditional IRA or take a tax credit for contributions to a qualifying retirement plan. You may be eligible for a tax credit or deduction for education expenses such as tuition and fees, textbooks, and student loan interest. Energy efficient home improvements. So you may be able to take a tax credit for making energy efficient upgrades to your home. You may be able to take a tax credit for expenses related to caring for a child or a dependent. And you may be able to take a tax credit for expenses related to adopting a child. These are just a few examples of tax breaks that may be available to you when you're preparing your taxes. Of course, it's important to carefully review the tax code and seek the advice of a tax professional or use tax preparation software to determine which tax breaks apply to your situation. So, knowing unusual tax deduction rules. While many tax deductions are well known, there are some unusual tax deductions that you may not be aware of. Here are a few examples of unusual tax deductions that you may be able to claim. So, home office expenses. If you use a portion of your home exclusively for business purposes, you may be able to deduct a portion of your mortgage interest, property taxes, insurance, utilities, and other expenses. Job hunting expenses. If you're looking for a new job in your current occupation, you may be able to deduct expenses related to your job search, such as resume preparation, travel, and employment agency fees. Moving and expenses. If you move due to change in your job or business location, you may be able to deduct certain expenses related to the move, such as the cost of transportation and temporary living expenses. Personal property taxes. If you live in a state that imposes a tax on personal property, such as a tax on your vehicles, you may be able to deduct the tax on your federal tax return. Casualty and theft loss. If you suffer a loss due to theft, a natural disaster, or other unexpected event, you may be able to deduct the amount of loss subject to certain limitations. Now, jury duty pay. If your employer pays you while you're serving on jury, you may be able to deduct the amount of the pay that you don't include in your income. Investment expenses. If you have investment income, you may be able to deduct certain expenses related to managing your investments, such as investment counseling fees and safe deposit box rental fees. Now, keeping track of your spending. Keeping track of your spending throughout the year is an important part of preparing your taxes. Accurately tracking your expenses can help you maximize your tax deductions and reduce your taxable income. Here are a few tips for keeping track of your spending. Use a budgeting app or software. There are many apps and software programs available that can help you track your spending and categorize your expenses. Keep receipts. You keep receipts for all of your purchases and make sure to save receipts for expenses that may be tax deductible, such as charitable donations, medical expenses, and job-related expenses. Use a credit card. If you use a credit card for most of your purchases, you can use your credit card statements to track your spending and categorize your expenses. Keep track of mileage. If you use your personal vehicle for business purposes, make sure to keep track of your mileage, as you may be able to deduct the cost of operating your vehicle on your tax return. Now keep track of investment expenses. If you have an investment income, make sure to keep track of any expenses related to managing your investments, such as investment counseling fees and safe deposit box rental fees. By keeping track of your spending throughout the year, you can ensure that you have all the information you need to prepare your taxes accurately and take advantage of all the available tax deductions. Additionally, you have a clear picture of your spending can help you make informed decisions about your finances throughout the year. The importance of accurate record keeping. So, accurate record keeping is crucial when it comes to preparing your taxes. Here are a few reasons why. Evidence of income and deductions. Accurate record keeping provides income of your income and deductions which are necessary when preparing your tax return. Accurate record keeping helps ensure that you comply with tax laws, which can help you avoid penalties, interest, and other consequences from the IRS. Accurate record keeping makes it easier and more efficient to prepare your tax return. When you have accurate records, you can quickly find the information you need to complete your return, and you can be confident that you have reported all of your income and deductions. If you're audited by the IRS, accurate record keeping will help you prove your income and deductions and provide evidence of your compliance with tax laws. Accurate record keeping can help you claim any deductions or credits that you are entitled to, which can increase your refund or reduce the amount you owe. To maintain accurate records, it's important to keep receipts, invoices, bank statements, and other records that show your income and deductions. You should also organize these records in a way that make it easy to find the information you need when preparing your tax return. Understanding the alternative minimum tax. The alternative minimum tax, AMT, is a separate tax system that runs a parallel to the regular tax system and is designed to ensure that taxpayers with high income or certain tax preferences pay a minimum amount of tax. Here are some important points to understand about the AMT. So, the AMT is designed to ensure that taxpayers with high income or certain tax preferences pay a minimum amount of tax. It is intended to prevent taxpayers from using deductions, credits, and other tax benefits to significantly reduce their tax liability. The AMT is calculated by adding back certain deductions, such as state and local taxes, and subtracting an exemption amount. The resulting taxable income is when taxed at a flat rate, which is 26% or 28% depending on the amount of income. The AMT is triggered when taxpayers' taxable income after adjustments and preference items exceeds the AMT's exception amount. The AMT exception amount is subject to inflation adjustments and is phased out at higher levels of income. The AMT can have a significant impact on taxpayers as it often results in a higher tax liability. Taxpayers who are subject to the AMT may also be unable to use certain tax benefits, such as such as deductions for state and local taxes that are disallowed under the AMT. So to avoid or minimize the impact of the AMT, it's important to understand the factors that trigger the AMT, such as high income, certain tax preferences, and deductions for state and local taxes. Taxpayers can also consider strategies such as timing the recognition of income or acceleration deductions to minimize the impact of AMT. It's important to note that AMT can be complex and often requires the assistance of a tax professional to fully understand its impact. Capital gains and losses. Now, just give me 1 second, everyone. Just 1 second. All right, sorry about that. I'm back. Capital gains and losses are an important factor to consider when preparing your taxes. Capital gains and losses arise from the sale of assets such as stocks, bonds, and real estate and personal property, and they have a significant impact on your tax liability. So here are some important points to understand about capital gains and losses. A capital gain is the profit that results from selling an asset for more than its purchase price. Capital gains are taxed as either long-term or short-term, depending on how long the asset was held. Long-term capital gains, which result from assets held for more than 1 year, are generally taxed at a lower rate than short-term capital gains, which result from assets held for 1 year or less. And capital losses. A capital loss is a result of selling an asset for less than its purchase price. Capital losses can be used to offset capital gains, and if they exceed capital gains, they can be used to offset up to $3,000 of other taxable income. Any unused capital losses can be carried forward to future tax years. Basis. The basis of an asset is its cost, which is used to calculate capital gains and losses. The basis of an asset may be increased by various factors, such as improvements, and it may be reduced by certain deductions, such as depreciation. A realized gain or loss occurs when an asset is sold. An unrealized gain or loss is a paper gain or loss that occurs when the value of an asset increases or decreases, but the asset has not been sold. Unrealized gains and losses are not taxed until they are realized. Tax planning. So, tax planning can help minimize the impact of capital gains and losses on your tax liability. For example, by carefully timing the sale of assets and taking advantage of tax loss harvesting, you may be able to minimize your tax liability. Additionally, holding assets for longer periods of time. Wait, sorry. My computer just went black for a second. Can you still see it, Israel?
Yeah, we see your screen.
You can still see it? Okay. Um, I don't know why I can't see it.
Can you see us, Damien, or just the PowerPoint went out?
All right, I can still see you guys. So, I mean, if you could see my screen, that's fine. I can't see my screen anymore for some reason. Okay. So
I'd say maybe just like try to disconnect from the Zoom and then connect again.
you could see the screen though, right?
Yeah, we can, yeah.
Okay, when I try and switch the slide, let me know if you could see that the slide switched because I could go back to like Google Slides and just.
Okay.
All right.
Oh,
All right. So tax planning. Tax planning can help minimize the impact of capital gains and losses on your tax liability. For example, by carefully timing the sale of assets and t and taking advantage of tax loss harvesting, you may be able to minimize your tax liability. Additionally, holding assets for longer periods of time may result in lower tax rates on long-term capital gains. It's important to note that tax rules for capital gains and losses can be complex and often require the assistance of a tax professional to fully understand their impact. Now, dealing with retirement accounts. So, retirement accounts are an important factor to consider when preparing your taxes. Retirement accounts, such as traditional IRAs and employer-sponsored plans, such as 401ks, can have a significant impact on your tax liability. Here are some important points to understand about retirement accounts and taxes. So, contributions to traditional IRAs may be tax deductible, while contributions to Roth IRAs are made with after-tax dollars and are not tax deductible. Employers Employer-sponsored plans such as 401ks may offer pre-tax contribution options which reduce your taxable income in the year you will make the contribution. Distributions from traditional IRAs are taxed as ordinary income, while qualified distributions from Roth IRAs are tax-free. Distributions from employer-sponsored plans such as 401ks are taxed as ordinary income. Required minimum distributions, RMDs, are mandatory distributions that must be taken from traditional IRAs and employer-sponsored plans once you reach age 72. RMDs are taxed as ordinary income. Rollovers allow you to transfer funds from one retirement account to another without incurring taxes or penalties. There are certain rules and restrictions that must be followed to ensure a rollover is done correctly. Withdrawals from retirement accounts before age 59 may be subject to a 10% early withdrawal penalty in addition to ordinary income taxes. A conversion allows you to change your traditional IRA to a Roth IRA, which may provide tax benefits in the future. However, conversions are subject to taxes in the year they are made. Retirement account distributions for first-time homebuyers. First-time homebuyers may be able to take a tax-free distribution of up to $10,000 from an IRA to purchase a home. Oh, I forgot to ask. Did it work
Yeah,
when I
yeah,
sh
yeah.
okay. All right, understanding self-employment taxes. So self-employment taxes refers to taxes that self-employed individuals must pay on their self-employment income. If you are self-employed, it's important to understand that self-employment taxes you may be required to pay. Here are some important points to consider when it comes to self-employment taxes. So self-employment income includes any income you earn from sole prior prop I don't know why I always mess up that word, but partnership or as an independent contractor. The self-employment tax rate from 2021 is 15.3%, which includes both the employer and employee portions of Social Security and Medicare taxes. You can deduct half of your self-employment tax on your tax return as an adjustment to your income. This return, this reduces your taxable income and therefore your overall tax liability. Um, self-employment Self-employed individuals are genuinely required to make an estimated tax payments throughout the year to avoid underpayment penalties. Business expenses incurred as part of your self-employment activities are generally tax deductible, reducing your taxable self-employment income. Accurate record keeping is critical for self-employed individuals in order to accurately calculate self-employment income and deductible expenses. Self-employment income must be reported on Schedule C, Form 1040, if you have a sole proprietorship, or Schedule E, if you have a partnership, or an independent contractor. It's important to note that tax rules for self-employment can be complex and often require an assistance of tax professionals to fully understand their impact. Okay, so the home office deduction. The home office deduction is a tax deduction available to individuals who use a portion of their home for business purposes. Here are some important points to consider when it comes to home office deduction. So, eligibility, to be eligible for home office deduction, you must regularly use a portion of your home exclusively for business purposes. This means that the space must be used only for business and not for personal purposes. The home office deduction is available to individuals who work from home as self-employed individuals, freelancers, or remote employees. The amount of the home office deduction is based on the percentage of your home that is used for business purposes. For example, if your home office takes up 10% of the total square footage of your home, you can deduct 10% of certain home-related expenses, such as mortgage interest, property taxes, and insurance. The home office deduction can be used to offset expenses such as mortgage interest, property taxes, insurance, utilities, repairs, and depreciation. Accurate record keeping is critical for individuals claiming the home office deduction, as the IRS requires documentation of the calculation of the deduction and expenses being claimed. There are limits to the home office deduction, and it may not be available to individuals who are employees and do not operate a home-based business. It's important to note that the home office deduction is a complex tax provision and is recommended that individuals consult with a tax professional to determine their eligibility and the amount of deduction they can claim. So the child and dependent care tax credit. So the child and dependent care tax credit is tax credit available to individuals who pay for the care of a qualifying individual, such as a child under the age of 13, a disabled spouse, or a dependent, such as the individual, so that the individual can work or look for work. Here are some important points to consider when it comes to the child and dependent care tax credit. So to be eligible for the child and dependent care tax credit, the individual must have earned income and must have paid for the care of a qualifying individual. The individual must also provide the caregiver's name, address, and taxpayer identification number. Um, the maximum amount of expenses that can be claimed for the child and dependent care tax credit is $3,000 for one qualifying individual or $6,000 for two or more qualifying individuals. The credit amount by is a percentage of the expenses paid for the care of a qualifying individual, with the percentage varying based on the individual's income. The maximum credit amount is 35% of the expenses paid for the care of the qualifying individual, or up to $3,000, whichever is less. Qualifying expenses for the child and dependent care tax credit include payments made to a caregiver, such as a daycare center, a babysitter, or a relative, for the care of a qualifying individual. Accurate record keeping is critical for individuals claiming the child independent care tax credit, as the IRS requires documentation of the expenses being claimed and the caregiver's name, address, and taxpayer identification number. The child independent care tax credit is subject to certain limitations and phase outs, and it may not be available to individuals who are married but filing separately or have been modified adjusted gross income above certain levels. Okay, so understanding the earned income tax credit. So to be eligible for the EITC, individuals must have earned income from employment, self-employment, or from farm work. They must also have a valid social security number and must not be a qualifying child of another individual. The EITC has specific income limits, and the credit amount varies based on the individual's income and the number of qualifying children they have. Individuals with no qualifying children and lower incomes will receive a smaller credit, while individuals with higher income and multiple qualifying children will receive a larger credit. The maximum EITC credit amount is $6,728 for individuals with three or more qualifying children, 5,728 for individuals with two qualifying children, 3,584 for individuals with one qualifying child, and 538 for individuals with no qualifying children. Qualifying children, a qualifying child for the EITC must be under the age of 19 or under the age of 24 or under the age of 24 if a full-time student, and must live with the individual for more than half of the year. Accurate record keeping is critical for individuals claiming the EITC as the IRS requires documentation of income, expenses, and the Social Security numbers of all qualifying children. The EITC is subject to certain limitations and phase-outs, and it may not be available to individuals who have modified adjusted gross income above certain levels. Sorry, did I just switch? I didn't even do that. Okay. Understanding tax laws. So, understanding tax laws is an important aspect of tax preparation. Here are some important points to consider when it comes to tax laws. Tax laws are constantly being updated and revised, so it's important to stay informed of any changes that may affect your tax situation. It's important to have a good understanding of the tax code to know what deductions, credits, and other benefits you may be eligible for. Tax laws can be complex, and if you're unsure about how particular tax laws applies to your situations, it's best to seek the help of a tax professional. Filing your taxes on time is important, as failure to do so can result in late filing penalties and interest charges. Tax planning involves anticipating and minimizing your tax liability by making smart financial decisions throughout the year. Accurate record keeping is essential when it comes to preparing your taxes, as it can help you claim all eligible deductions and credits and avoid errors on your tax return. It is important to be aware of deadlines, as missing a deadline could result in penalties and interest charges. Major life events such as marriage, birth of a child, and retirement can have a significant impact on your tax situation, so it's important to understand the tax implications of these events. And tax deadlines. So it's important to be aware of tax deadlines to avoid penalties and interest charges. Here are some important tax deadlines to keep in mind. January 1st, the start of the tax year. This is the date most tax-related items such as income and expenses begin to occur. April 15th, the deadline for filing federal income tax for returns for individuals. This is also the deadline for making tax payments unless an extension has been granted. June 15th, the deadline for filing a tax extension for individuals. This extension provides an additional 6 months to file your tax return. September 15th, the deadline for individuals who have been granted a tax extension to file their tax return. The January 15th, the deadline for individuals to make estimated tax payments for the previous tax year. February 28th, the deadline for businesses to file W-2 forms with Social Security Administration. March 15th, the deadline for corporations to file their federal tax return. So obviously, it's important to note that these deadlines may vary depending on your state of residence and the type of tax you're filing. So filing an extension allows taxpayers to request additional time to file their tax return. So completing Form 4868, this form is used to request an extension of time to file your federal income tax return. You can submit Form 4868 either electronically or by mail. If you're filing electronically, you can use the IRS e-file service. If you're filing by mail, you must send Form 4868 to the IRS by the tax filing deadline. If you owe taxes, it's important to pay as much as possible by the tax filing deadline to avoid penalties and interest charges. You file your tax returns by the extended deadline. The extended deadline for individuals is October 15th. Just make sure to complete your tax return by this date to avoid any additional penalties or interest charges. So this is an example of 4868, Form 4868. So Sorry. So the purpose of Form 4860 is used to request an extension of time to file your federal income tax return. The form must be submitted by the tax filing deadline to request an extension. An extension of time to file your tax return does not extend the time to pay taxes owed. If you owe taxes, you must pay them by the original tax filing deadline to avoid penalties and interest charges. You can file Form 4868 either electronically or by mail. If you're filing electronically, you can use IRS e-file. You can use an IRS e-file service. If you're filing by mail, you must send Form 4868 to the IRS by the tax filing deadline. The extended deadline for individuals is October 15th. You must file your tax return by the date to avoid additional penalties and interest charges. Make sure to provide accurate information on Form 4868, including your name, social security number, and estimated tax liability. So Form 4868 must be signed and dated by the taxpayer. And if you're making a payment of estimated tax, you can include it with Form 4868. Okay, so common tax filing mistakes. Um, Incorrect social security number. Make sure that the social security numbers for you, your spouse, and dependents are correct. Double check your math and calculations to avoid errors. Make sure to complete all required fields and provide all necessary information. Choose the correct filing status as it can affect your tax liability. Be sure to sign and date the return. If filing a joint return, both spouses must sign. Make sure to report all income, including taxable and non-taxable sources. Don't overlook deductions and credits that you may be eligible for, such as a mortgage interest deduction or the child tax credit. If you are self-employed, be sure to report all self-employment income and expenses. Tips are taxable income and must be reported. Gambling winnings are taxable income and must be reported. And let's see here. We'll just do a summary. And so, the summary of filing your taxes. Filing your tax. Also, determining your filing status. Your filing status determines. By the way, this is the last slide. All right. No, this was a pretty long one, but this is just the last one. We'll wrap it up right here. Your filing status determines your tax rate and forms that you'll need to file. Collect all the necessary documents and forms, including W-2s, 1099s, and receipts for deductions. Common tax deductions include mortgage interest, charitable contributions, and medical expenses. Tax returns are due by April 15th each year. If you need more time to file, you can request an extension using Form 4868. If you have a complex tax situation or are unaware about how to file your taxes, you may want to consider hiring a tax professional. Accurate and thorough record keeping is important to ensure you receive all your tax benefits you're entitled to and to avoid penalties and audits. Be cautious when sharing personal information and be aware of potential tax scams, such as unsolicited phone calls or emails from someone claiming to be from the IRS. By following these steps, you can ensure that you file your taxes accurately and on time and receive the maximum tax benefits you are entitled to. And that is all for today. Hopefully, everybody now knows how to do their own taxes on their own, every single kind, every form that we talked about. I'm obviously joking. All right, everybody can, if you didn't get to attendance, you could sign here, sign in here. And if anybody has any questions, just let me know.
Thank you, Damon.
Of course,
Thank you.
Israel. Thank you. Thank you for having your camera on too.
I got you. You do your own taxes or not yet?
Not yet, but now I know everything, so I might do it this year.
Do it. Do it now while it's simple.
Yeah, I will.
Or you start making big money and then you gotta hire someone.
Right.
All right, man. Have a good day.
All right, you too. Take care.
Good night, everyone.
Thanks, Damien.
Damien, do you want to meet now?